Hey guys, so let's carry out our discussion on the valuations column. So the first thing that we're going to discuss is market cap at last close. So as the name suggests, this is basically the total amount, the total value of the stocks in the market. So that is basically the amount of the number of outstanding shares multiplied by the current value of the share. So basically, in summary, this will just tell you how big the company is right now. So a very quick way to basically, this is very important factor, and almost no one trades without looking into this particular factor, because if the company is too small, there can be a huge liquidity risk, but not necessarily a big company means profits. It has to be combined with other things. But if you go to screeners, I'll just open a new tab and just go to heat map view. This is if you see here, these are the top companies by top US companies by market cap. So if you see, Nvidia is 1.66% today. That's a day written, by the way, but it is 4.66 trillion market cap, and that is followed by, I think, Google 3.77. Oh no, actually Apple, which is $4 trillion. So basically, it's a very solid indicator of how reliable the company is. The bigger company means it's really doing good right now. So mostly it's a good indicator of whether the company can be considered a good investment or not. Next, we're going to look into the EV by EBITDA, which is the total enterprise value divided by EBITDA. Now, what is total enterprise value, or what is enterprise value? So enterprise value is basically the price that you can pay today to buy the company outright. So basically, it's a sum of market cap, total debt, and if there is any preferred equity, then add that to any minority interest, and then subtract all the cash and equivalent, and that gives you approximately the enterprise value of the company. And as I discussed already, what is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a kind of proxy for operating cash earnings before financing and non-cash accounting charges. Now, EV by EBITDA. Why do we need to divide EV by EBITDA? That gives you a very standard factor, which is also called enterprise multiple, by the way, and it's a very good indicator for the valuation of the company. So EV by EBITDA tells you how many years of current EBITDA would in theory be needed to pay back the enterprise value. So if EBITDA were constantly and fully available, then how many years would be required to pay back the entire value of the enterprise? A ratio of 8 means the enterprise value is 8 times EBITDA. Now, the relative valuations, let's talk about that. It is mainly used to compare companies within the same industry. A lower EV to EBITDA can suggest a cheaper stock, and higher one a more expensive stock, assuming similar growth and risk. So that's how you can compare the companies. It's just, let's say you're just buying a company, and if you're investing in a company, let's say just by buying stock, then you can obviously consider yourself as an investor, just like you're going to buy a company. And then if you calculate EV by EBITDA, then you have a very good, that's a very good benchmark of the, relative valuation compared to the other companies within the same industry. But unlike price to earning ratio, the EV to EBITDA incorporates debt and cash. So it is less distorted by how a company is financed and is widely used in mergers and acquisitions and professional valuation work. So that is basically the enterprise value by EBITDA. And if we see EV to EBITDA numbers here, Nvidia has 40, Apple has 23, Google 24, Microsoft has 16. So what does that mean? It means that you will need 40 years on the current EBITDA to pay the entire value of the company, which is very counterintuitive. So why is Nvidia a good stock right now? I mean, doesn't that mean that it's expensive? So the thing is, yes, it does. However, it also means that if people are willing to pay a lot of money, so that means the share prices are high, and multiply that with the number of shares, that is your total enterprise value. If that is high compared to what the company is earning right now, that means the people are, the investors are very positive, very bullish about the company. So they see the company has a very very high, very good future, right? So that is why they are willing to pay more to buy each share of the company, because they see the graph to go like this. So yeah, I mean, this number doesn't necessarily mean it's a bad investment. But for example, here, see, 125. Tesla has 125 EV to EBITDA ratio, which is quite steep. And given the entry of Chinese car makers, I don't even know if that's going to be a right investment right now. But anyway, that is everything about enterprise value divided by EBITDA. But if there is a business which is comparatively stable, and it's like not a new business, not a new territory, then it will have a lower EV to EBITDA rating. Like Berkshire Hathaway, it has 8. So if you have like this much money, 1.075 trillion money, you will and you buy the company, you can recover that money in 8 years. And yeah, I mean, that's not bad. And you can even make profits after that. But if you another like Walmart, you will pay back 20.56, which is still decent. All right, so moving on, we will now look into price to tangible book value metrics. So there is another metric called price to book value, but this is different. This one is price to tangible book value metric. So what does this tell you? So this basically tells you, if you, let's say, if you buy the company outright, and even if it stops its business activity completely, it will have some tangible assets under it. So it, like current cash, physical assets, maybe properties. And so all the assets excluding non-tangible assets like goodwill, maybe intellectual properties, those kind of things. So if you take all the value of the book value of all the tangible assets. Now keep in mind, the book value can sometimes be overstated, but let's not go there. if we take the book value of all the tangible assets and distribute it amongst all the available shares of the company, right? So we have a value, and now if we divide price by that value, that gives us price by tangible book value. So if this ratio is less than 1, for example, that means that if I purchase the company, and even if it completely stops doing any business activity, then I can, in theory, sell all the assets and get a profit. You sell all the tangible assets of the company and still be in profit. However, you have to keep in mind that the book value, they are just not the real indicator of actual current market value of the physical assets, because of various accounting practices. It can be overstated. It's not always right. However, this is a I mean, if the value goes below 1, it's a good indicator that it's it's a indicator that the company is undervalued. So if you're planning to go with this metrics, then there's a word of caution. If I think everybody knows what happens to Lehman Brothers in 2008. It was trading at the price to tangible book value below 1 in the months before bankruptcy, with tangible book value per share around $30 to $40, while the shares fell to just about 21 pence. Shareholder received zero in liquidation, as assets sales fetched only like 20 to 30% of the book value, after covering a whopping $600 billion plus in liabilities, legal fees, and there were also priority creditors, highlighting how the forced liquidation destroys value. So what are the key lessons from this case? The key lessons are that real estate, securities, and derivatives sold at fire sale discounts during the market panic. And liabilities as well. So combining these two things, it ate away all the value. So even though the book value was good, but investors didn't get anything. So the next thing that we are going to discuss is total enterprise value by earnings before interest and taxes. Now, this is similar to the enterprise value by EBITDA, but including depreciation and amortization impacts for a stricter profitability view. So TEV by EBIT, which is earnings before interest and taxes, is a valuation multiple that divides the company's full enterprise value by its operating profits, which is the earning before interest and taxes, accessing cost per unit of core earnings while also factoring in the debt. So as simple as that. But this is also a very heavily used indicator, especially because it enables a fair cross-company comparison. So next up is price to sales ratio. So price to sales ratio measures a company's market value, which is the total market cap, and divided by total revenue, showing how much investors pay per dollar of sales. It is ideal for valuing unprofitable growth stocks where earnings are volatile and negative. But PS is perfect for growth stock because revenue is harder to fake, and you can fake earnings, you can manipulate your books and fake earnings, but revenue itself is very hard to fake. So it lets you spot scalable businesses very early. Use it by seeking low price to sales, like under 5 for tech companies. Combined with you can combine it with like 20% plus sales growth, improving margins and unreasonable, or or um, mm, you can say reasonable debt to find growth at a reasonable price. Now, price to sales is not as comprehensive as enterprise value to sales ratio, because enterprise value to sales ratio measures a company's total value, including the debt and the cash, divided by its revenue, providing a debt adjusted view of price per dollar of sales that is more comprehensive than price to sales for computing for comparing firms with different kind of capital structures. Now, next up is price to book value. So we already discussed price to tangible book value, but this one is price to book value. Now, what is price to book value? So price to book value compares a stock market price per share to its book value per share, which is total assets minus liabilities divided by outstanding number of shares. So what it reveals is if the market values the company above or below its net asset based on the balance sheet. What are the differences between the price to tangible book value and price to book value? So price to book value includes all assets like tangibles plus intangibles like goodwill, intellectual properties, while price to tangible book value excludes intangibles for a strict liquidation focused view. So you mostly look into price to tangible asset value for when you view you're valuing a company focusing the liquidation, but you use price to book value for growth firms with valuable brands, price to total book value for very asset heavy or distressed companies like banks or manufacturing companies. So the key differences are that price to book value, does it include tangibles? Yes, price to book value includes tangibles, and normally when the outlook is moderately conservative. It is best used with tech services, and values future earning potential. So not necessarily something which we are analyzing based on its focusing on its liquidation, whereas price to tangible book value, it obviously doesn't include intangibles, but when we see this value, we are very highly conservative, and it is mostly used for industries like banks, you know industrials, those kind of things. Now, price to tangible book value often shows higher ratios than price to book value in intangible heavy firms, revealing true asset backing. Yeah, and the next one that we're going to discuss is price to earning ratio, which I have already discussed in the previous video, but simply put, price to earning ratio divides a stock's current price by its earnings per share, usually over the last 12 months, to show how much investors pay per dollar of profit. So a low price to earning may signal undervaluation and a high price to earning growth expectations. Now this is again not used alone, and it varies by industry and sectors, so it has to be used in context with other indicators. And similar to price to earning ratio, I have previously discussed price to PEG. So basically this is called PEG in short form, price to earnings to growth ratio and price to book ratio. But I'll quickly go through it once again. Basically, PEG ratio, or price divided by earnings to growth, divides a stock's price to earning ratio by its expected annual earnings per share growth rate in percentage term, normalizing high PE valuations for fast growing companies. So basically, why do we use PEG ratio is because this will normally normalize this ratio across industries. Now, a PEG near or below 1 suggests a fair value relative to the growth prospects. And price to book ratio divides a stock's market price per share by its book value per share, which is total assets minus total liabilities divided by outstanding number of shares in the market, to gauge if the market values the companies above or below its net accounting assets. So the ratios below 1 signaling potential undervaluation, especially if it's asset heavy firm, and above 1 reflecting growth or maybe intangibles. So that concludes all the factors with respect to valuations that are available in Yahoo Finance. I think we can finish off this video now, and in the next video we can discuss financials. And financials are basically divided into 3 different categories: cash flow, balance sheet, and income statement. And I'll see if I can do all of them in one video, or we will split videos. But yeah, financials coming up next. See you guys. Bye.